Okay, welcome back to the Road to Retirement. My name is Chris Anselmo with Brookside Tax and Financial Group, and along with me, my co-host Tony Shore. How you doing, Tony?
Chris Anselmo, great to see you again. Great to be on the show
Yeah,
once again. It's been too long.
yeah, it's been a while. We probably haven't done one. I'm not even sure we did one this year. So, we came through tax season. Tax season eats up the first quarter of the year for us, and we're so inundated. It's a good thing, we do a lot of tax. We do like 3,000 tax returns in 10 weeks, so it's a little crazy. It's funny since sometimes people on the other side of the desk are like, "Oh, I can't. I was just getting my tax return together." I'm like, "You should be on this side of the desk." And then they're like, "Oh, okay, yeah, right." You only have to worry about one tax return.
Yeah. Yeah.
So everything's good on our side.
Good. You
Um,
made it through another tax season. I know you
yep,
guys get really busy. I mean, in addition to your financial advisory and retirement planning, you've got a great staff and team there, though.
we do have a great staff, and we're looking to add two more staff members too. So the firm's growing, which is good.
Yeah.
We hired another attorney, Zach, who's handling a lot of the estate planning
Oh,
for
good.
us.
Yeah.
And we're going to hopefully hire him a paralegal. And we're also going to get another, what we call a client service specialist, which is the person who helps do all the applications and, moving the money from one company to the other. So give Morgan some relief. And hopefully we are going to move Morgan up into a better role. And, but all's good.
Awesome.
Yeah.
Wow. Yeah, I know you keep growing and your clients love working with you. And I think what the difference is and what people don't realize about financial planning and retirement planning, investments, taxes, there's so much that goes into it. And you really need somebody who knows all the areas and
Yeah.
has people, estate planning attorneys, tax professionals, financial advisors, wealth management to put the whole package together. And there aren't many firms out there that have a team like yours that do that.
Well, I appreciate that. It took a long, hard road to get it all in place. We had to get a lot of licensing done, attorneys,
Oh,
CPAs, insurance people.
and it's ongoing, right? I mean,
Yeah,
you're I
yeah,
mean, you're held to these standards and the state
yeah,
and
yeah. We're
and
fiduciary, so we
yeah,
have an annual audit by the state that comes in and goes over what we do and hopefully gives us their blessing. And
sure.
our state's pretty cool that they're really there to try to make you do it right. They're not in there like trying to find things that you're
Right.
doing, to penalize you or anything, but they really they want it to be best for the client. So it's been a tough road, but it's a good road, and the clients are appreciating it that they could get everything one stop shop. But
Yeah.
so today's topic, we are talking investing with protection and picking your protection. So there's a lot of products probably in the last 2 or 3 years that have come out that um, allow you to have some level of protection even while being in the market. Or for a long time that was probably limited to indexed annuities, where they've probably been around for about 20 years now, where you're not really in the market but your interest rates linked to an index. So that was 100% protection, but you kind of had limited upside. Generally those would probably um, earn anywhere from 2 to 6% in any overall, but they really were trying to competing with bank products and not really competing head to head with the market.
Right. Just trying to outperform CDs and give you a little
Right.
more of an option. Yeah.
Right. And a lot of our clients, that's a good portion of their nest egg, because they were bank people, and they just want, like, they don't want to take any risks.
Right.
But so a lot of things come along the last couple of years that allow you to be actually in the market but have some protection, where traditionally how you try to do protection was 60/40, put so much in bonds and hopefully that's your protection.
The old 60 in stocks, 40 in
Right.
bonds, and the bonds were your
Yeah.
protection, but
But
that's kind of gone the way of
yeah,
the pension or
yeah,
the buffalo.
the bond market has been, because of interest rates, how they've changed over the last several years. For a while they're super low, like CDs were paying less than a 1%. So when interest rates are super low, it's hard to get good bond rates. But then when interest rates go up, bonds go up, and then when interest rates go up, those bonds that are on the books with lower rates are going to go down. So it was really a struggle for the last half a dozen years or so to get competitive rates
Yeah.
in the bond market. So
It's been bad. Yeah, the
yeah,
bond market has not been good. But Chris, before we go on, you're talking about protection, and you use
right.
that word a lot. When you're talking about protection, what do you mean by protection?
Okay.
You're
So
talking about protecting your principal, right?
and some of the interest that you gain. So I'm going to try and share my screen and just so
Okay.
I did a little word perfect document.
Ah,
so
word perfect.
so don't beat
Don't
me up
show
on
your
word
age.
perfect. Um, okay, can you guys see that?
Yep.
Okay, so
Pick your protection.
I'm not sure how to expand my screen, but that's okay. So picking your protection. So some new and innovative products have come out over the last several, 2 or 3 years. Whether they're private offerings like Gradient has, where they either go to a bank or a financial institution and create a product that has some levels of protection. So anywhere from 10, 20, even 100% protection on the downside. It might be a year-long product. So they'll
Is that a buffered index portfolio you're talking about?
correct. So usually it's one of the big banks that offer this type of strategy. So they might say, "Look, you give us your money for a year, we're going to guarantee that you won't lose any money, and your upside might be, let's say, I don't know, 8 to 10%."
Yep.
And so if the market goes down, you don't lose anything. The market goes up, you're capped out at that rate, but
Right.
you knew that going in, right? So
Right.
um, like nobody can offer you protection and give you 100% of the market, right? Because there's some cost to them to creating this protection level. So if you want protection, ultimately you're paying for it on the upside potential. So
Right.
now these private offerings are I call them private offerings, but the buffered index portfolios are there could be a range of them. There could be a 20% buffer, so you get a little more upside. There might be a 50% buffer, you get a little more upside. So depending on how much protection you want, you pick your basically your buffer. So your buffer is kind of like uh, the bowling alley when the kids are up, you put those little uh, gutter guards
Oh, yeah.
yeah, right. So
Yeah.
so basically you're picking your protection. If you want 100% protection, then you're going to use a bank product or some type of index annuity where if the market goes down, you lose a penny. Right. So what came along are these private offerings. There's also some companies that have created ETFs with built-in buffers anywhere from 5% to 9% to 30% to 40%. And Gradient has an offering now with ETFs that can do that. So what happens there is they're called defined outcomes. So they will tell you when you open the account, let's say it's a 10% buffer in the next, and then you're going to have a cap over the next year, say of, I don't know, 15%. So if the market goes up 30, you're only getting 15. But if the market goes down, your first 10% is protected. Or you can pick whatever buffer they have. Some have 9, 15, 30, 40. So again, as you get to pick how much risk you want to take on that market participating product. So now those are you're actually in the market as compared to fixed annuities. You're not in the market, right? You're just getting a flat rate of interest. So a regular fixed annuity, ABC Insurance Company says, "Look, you give us your money for 5 years, we're going to pay you 5%."
Yeah.
Right.
Even a fixed indexed annuity that is based off of an index like
Right.
the S&P 500, you're not actually in the market.
Correct. Right.
Right.
So
I mean, they use the S&P
yeah.
500 as when it goes up, you can make a certain portion of that. When it goes down, you're protected against the downside. But that you're not at your money's not actually in those stocks
Right. Right.
directly. But with a buffered index portfolio through an investment company like Gradient Investments, that money is in that index, but they just offer a protection. You don't get all of the upside, but
Correct.
you also don't have downside. You can protect the
Right.
principal,
So
is what you're
so
saying.
any fixed product fixed is not in the market.
Right.
So whether it's a fixed, just a flat rate one that you're getting 5%, or the index one, you're not in the market. Now on the index side, the interest rate that you earn will be based on how well the index does,
Yeah,
whatever index it is. It could be the S&P, it could be the
sure.
Dow, it could be, there's a variety of indexes that companies use, but generally it's the S&P or the Dow. And so as that goes up, you're going to get some interest rate based on that index's performance. They now even have variable indexed annuities. So a variable indexed annuity will have some type of floor, some type of downside protection, and but you're actually in the market. So let's say you get
Oh,
one of the
wow.
so let's say you get
I
one of
didn't know
these
that.
at yeah. So let's say you get one of these and they say, look, we're going to give you a 10% downside protection. Okay. Now, as the variable annuity goes up and down, if it went down 15%, well, then you might be out 5%. So the first 10% in our example would be protected.
Yeah,
So
the company, the insurance company or
right,
the is so that one is more like the buffered index portfolio that you'd get
correct,
through an
correct,
investment firm.
right.
Yeah.
So generally, but on the flip side, if you have good years, those are going to do a little better than the fixed index annuities because
Oh, yeah.
you're not you're assuming some of the risk. So
Right.
the way we look at these is like if like most of our clients are not trying to hit home runs, right? They're not overly aggressive, they're not,
Right.
aggressive in the market. So if you're not looking for 100% performance, why not grab something that's got some protection? If the account makes 15% next year, the market did 30, you got 15. Well, 15's not bad, right?
Right. Especially as we get older and
Right.
closer to retirement or are in retirement,
Yeah.
you've got to have some of that protection because you don't want your retirement money at risk, right?
Right. Correct. And so
You don't
these
have that time period to make it back up.
yeah. So if I do this, if you could see it better. Okay. So all of these products we've been talking about have some type of levels of protection versus just blindly going buying mutual funds or stocks or bonds where you really don't have any downside protection unless you use stop losses and stuff like that, which are a whole nother show,
Sure.
right? So and most people, you know, don't know how to do that. So the buffers range from, we see them as low as five, and believe it or not, there's 100% buffers. Like basically on a fixed index annuity, it's 100%, right? There, you got the only way you're going to lose money, not the only way, but generally the only way you lose money is if you pull the amount of money out of the product early. So let's say Tony, you buy a 5-year fixed index annuity.
Right.
So basically, the insurance company says, "Look, we're going to give you this rate, whatever the rate is, because you're telling us, you're committing to us, you're signing a contract with us that says you're going to give us the money for 5 years. So
Right.
based on that commitment for 5 years, we can offer you this rate." Well, if you pull the money early, they're going to charge you a penalty because they said, you you broke the contract. You told us we were going to have the money for 5 years. Now we got to give it back to you. But we invested it like we were going to have 5 years to make this money work, and now we don't. So if you choose to break the contract, just like if you broke a CD early, you're inflicting the penalty, right? So it's not, and these penalties actually are not bad for one reason. So the reason they're not bad is sometimes that prevents people from um, panicking, right? So if they know they have a penalty to come out, they may stay in, and you know, so there's no run on the market. So,
Right.
but it's okay. So, and God forbid the other way is the insurance company go out of business. Now, generally, we haven't seen any of those, or if they do, another insurance company buys them up. And
And takes over the
yeah,
accounts.
in
And
most
so
states, and I know here in Ohio, we have a Ohio Guarantee Fund that would protect in that situation up to $250,000 per account
which is
per.
the same
Yeah,
amount you're getting
yeah,
protected by the FDIC
yeah.
in
It's
a
just
bank.
a
Yeah.
different method. So these buffers, anywhere as low as 5 and up to 100%. So again, as you if you want to take more of the risk, so let's say I'm going to take a 5% buffer, then
Mhm.
the company can offer me more upside because they know they don't have to bear the whole risk.
Yeah.
And as you get up, as those buffers go 5, 10, 20, 30, as you pick your protection level, look, you're going to earn less upside, but you may have more peace of mind knowing, good, I pick a 30% buffer. What are the odds the market goes down 30%? I mean, it rarely goes down 30%, maybe
Right.
5 times in history, right?
Yeah.
So you can kind of pick your downside protection, and I'm pretty comfortable now with. Why wouldn't you take some protection? Well, everything that's going on in the world right now,
Mhm.
and everything that's going on politically. I mean, this is going to be an election like no other election, right? And we got the problems in the Middle East. I mean, why not grab some protection? Why you can't?
Yeah.
So
Yeah, I mean, you have insurance on your car, you have insurance on
yeah,
your
yeah,
home, and hopefully your retirement income and your investments are even more than
yeah,
those are worth. Why wouldn't you insure them? I mean,
yeah,
I want to insure my retirement accounts, my investments, and as I get older, I want more protection.
yeah, yeah.
That's just, and it's not only me personally, what my personal risk tolerance changes as we get older. I think most people go more conservative. So I think that's important.
So let's talk about some of the techniques or things that you might hear in these products. So there's a few now that are actually in. We have one through Gradient too, called dual directional.
Oh yeah.
So the
This is
dual,
incredible,
yeah.
really.
So the dual directional says, let's say we give you a 10% dual directional figure. Okay. So they say if the market goes up, uh, the first 10%, you share in that 10%. Okay.
Yep.
If it goes up 20, you're only getting 10.
Right.
Okay. So this is the protection. On the downside, they say you also have the 10% on the way down. So if the market goes down, let's say it goes down 5%, you get 5%. The market goes down 10%, you get 10%. So it's dual direction. So if the market goes down 15, you might be out 5,
Right.
right?
So
So
if the market goes up 2, you're going to get 2.
right.
If the
So it's
market goes
gonna be
down 2, you're
there's
still going to get 2.
right, there's gonna be a cap on the upside and a cap on the downside.
Right.
So let's in our example, we said 10% both ways. So if it goes up 8%, you get 8. If it goes up 12, you get 10, right? If it goes up 2, you get 2. On the downside, if it goes down 5, you get 5.
Right.
If it goes down 10, you get 10. If it goes down 11, you're gonna be out. A 1, right? So, because the first 10% is protected. So, it's
That's
kind
amazing.
yeah, so, there these things that are out there that they haven't been out there before.
No.
So, maybe it's part of your portfolio.
Yeah, it's
So
like they've improved these investment vehicles so that because they're trying to attract people's money. They know people are
sure,
saving for
right,
retirement or investing, and they know they need to make it more attractive. And they need to, people aren't putting money in the market because of risk or because of what's going on in the world. So
yeah,
to get you to put your money and invest it, they're really making these attractive. I mean,
right,
from the buffered index portfolio, Chris, to the dual directional, which is even, I mean, I had to have it explained to me
yeah,
about 5 times before I could believe it. And, I work directly with the people at Gradient Investments
yeah,
as
sure,
well. And I've talked to them about it, and they have their own money in it. I mean,
yeah,
that's
I
what
I mean,
impresses me, because they're like, why, it's kind of a no-brainer, but
yeah,
again, everybody's situation is different. It
yeah,
depends on how much you have.
sure,
It depends on what your risk tolerance is and what you need and when you need it. So, these aren't cookie cutter options. It's
sure,
not,
and
there
and
is
it
no, it's like if something sounds too good to be true, it usually is. But like things like the buffered index portfolio and the dual directional you're talking about, it really does have some good upside. Now, if the market takes a 30% upswing, you're just not, there's some opportunity loss there because you're only going to get 10. But boy, as volatile as the market has been, that's why they created the dual directional, because
yeah.
people want to lock in gains.
A
And
and it depends where you get that strategy from. So if you get that dual directional one, let's say from one of those private offerings we talked about earlier.
Sure.
Those are considered alternative investments, and generally those there's restrictions on how much of your portfolio you can put in it.
Right.
Mostly, like you can only put like 25% of your portfolio in it. But there are some of these dual. There's some variable index annuities now that have this in there. So again, it really just depends on how much comfort level you want to be at. Now, look, the market did 30% last year, and you only get 10. Some people get ticked off. Right? They're
Yeah.
like, I could have got 30. I'm like, but you don't want to take the risk, right?
Right.
I mean, if you want to take the risk, we'll
Right.
throw it in there. But if it goes down 30, I don't want to hear about it, right?
Right. Right.
So there's also these things in some of these products called triggers. So one product that we use, let's say they give you a trigger rate of, we had them as high. They came down a little bit, but there was one that was 15% trigger rate.
What does that mean?
So that means, let's say you open the account today and there's $100,000 in it,
Hmm.
and it's linked to the S&P 500. Next year, if there's $100,000 in it, you get the trigger rate. You get 15%. No matter if it went up a penny or 2 pennies or 3 pennies, as long as it didn't go down, you get that whole rate, which is incredible. So we had someone a year ago or so, their account went up 0.74%. They got 15%.
Wow.
So the trigger is, as long as you meet that criteria, the switch turns on and you get that rate. Now, if it goes down $1, you get nothing, right? And they also have protection levels on it. They may have a 10 or 15 or 30% protection level. So the ones that we were using had a 15% protection level. So if the 100,000 turned into 85,000, they reimburse you. Okay, so you had some downside protection there, and
Oh,
then
wow. Okay.
there was a trigger rate. So the trigger rate said, let's say the trigger rate's 15. So you're 100. A year later, it's $100,000 and a penny. As long as it didn't go down, you get the trigger. So they gave you 15%. So there's triggers out there, and there's caps. Caps would be, look, we're going to limit how much you can make on the upside. So let's say the cap is 15%. Now, the difference there with a cap is you're not getting 15% unless the index goes up 15%.
Right.
Right? So it's oftentimes the caps are higher than the triggers,
Sure. Sure.
but you can pick and choose. This was this whole conversation is you can pick and choose what you want to do here. So, and some of the products have a little bit of both. So now percentage participation is, instead of having a cap, let's, in our example, 15%, they might say, we're going to give you 50% of whatever the index does. So if the index goes up 20, you get 10. It goes up 30, like you did a year ago, you get 15.
Sure.
So you get a percentage of the participation. Now, depending out your buffer, that'll be your level of protection. Like in an index annuity, the buffer's 100%, right? So, but the participation rate in an index annuity might be lower than in a variable annuity because you're not assuming the risk. So they might say you're only going to get 40% of the upside.
Right. Right.
Spreads are a little different. They'll give you a number. For instance, I think I put percent participation in there twice. So a spread would be, let's say the spread is 3%. So if the market goes up 10, you get 7. Right? If the market goes up 12, you get 9. So they
Oh, I see.
there's a spread, right? So there's also, I didn't put it in here, but there's also some that are just a fee, which I don't like, because the fee happens even if there's no performance. So if we say they're going to charge you, and normally what they do is, this is a type of product where they're going to give you a higher cap if you agree that we could charge you a fee. So let's say the fee is 1%.
So you
So
pay a 1% fee a year. And a lot of people don't realize they're paying fees within their 401ks or
right.
IRAs.
So you could even have indexed annuities that have a fee. But what
Right.
happens is, let's say that the cap is 10% on the normal one, right? They'll say, well, if you let us charge you a fee of 1%, we'll give you a cap of 15. Right. So there's a trade-off. You're going to pay some. What I don't like is the market goes down, you still pay the fee.
Right.
Right, so
That's not good. Yeah.
so I just thought we'd throw these out there today. I think we're almost out of time, but
Yeah.
I what I like about it is that people have more selections. They have more, instead of just traditional put 60% in the market and 40% in bonds.
Yeah.
We can go through these products and say, hey, like you're going to get a decent amount of upside. And again, our typical client is not trying to maximize performance. So um, the, these might be a good fit.
Yeah.
And
Back in the day, like my grandfather always talked to my grandparents, it was all about CDs, right? And so either you're a person who had your money in the stock market, which was really risky, or you didn't like risk, your option was a bank CD. And
right.
then when the interest rates were lower, you made 1%.
And a lot of our clients are still out there farming CDs, as I call it, because they don't know any of this stuff. Like they
Yeah.
didn't know this stuff's out there. And the
Right.
bank, look, these are all really to compete with the bank, right? The bank's not going to
Right.
tell you all this, right? So, and most people walk into a bank, what do you have? I got red and green apples.
Yeah.
You, that's all your selection is red and green.
Yeah.
But I need strawberries. We don't have them,
Yeah.
right? Again, let me give you our number 440-886-3550, or you can go to brooksidetax.com. I know we have a Facebook page, we have a YouTube page. I don't know all those particular
Just
handles,
look
but
up
yeah,
Brookside Tax.
yeah. Tony and Aaron do all that stuff for us.
Yep.
Tony Shore and his group over there. So, yeah, any closing comments, Tony?
No, I think that's great. And it's great to know that you can protect your investments,
Yeah,
especially those you're going to need in retirement. You don't want to have them all at risk. But again, you don't want all your eggs in one basket.
yeah.
So it's good to know there are a variety of options
Well,
out there.
lot of stuff out there now.
That's great. Good
Yeah.
show today, Chris.
Okay.
440-886-3550 or brooksidetax.com. Chris, great show today.
All right, thanks. I will see you in same bat time next week.
Yep. Thanks, Chris.
See you. Bye.